Good morning, Dennis Smith, and it's Wednesday morning, time for the 2-minute drill. Today we're going to talk about the soybean market and the increased demand curve for soybeans. Next week, by the way, we'll be talking about the hog market. Soybean futures began to explode in prices in mid-April, and this was happening on record large volume. Look at the price chart with a volume indicator underneath, and you see record large volume as this market began to explode higher. We went from roughly $9.60, an 80-cent rally on record large volume, stabilized, and now we're approaching $11, so we've gone up another 40 cents. Markets don't do this on high volume without a reason, and we're going to talk very briefly in the 2-minute drill about the reasons. Brazilian exports have been record large. They are exporting beans as fast as they can do it. Some say that Brazilian ending stocks are going to get very tight and are already very tight. Major shift in the demand curve is what's happening in this market. While most people are still focused on supply of Brazilian beans, supply of Argentina beans as they have a wet harvest, our supply as far as acreage and growing weather, the point is it's demand that is driving this market, not supply. Prices are low levels for a reason. They either are designed to stay low in times of excessive supply, to do one of two things, to discourage production or to increase demand. If you look at the weekly soybean chart, notice the period of about 7 months of stable prices between $8.50 and $9. This was the period prices were low enough for long enough to increase demand for soybeans. Nobody was aware this was happening. That's what makes predicting and understanding demand forces so extreme. That's a look at the soybean market on the 2-minute drill. These are my thoughts and not those of ADM or ADM Investor Services, nor are they the thoughts of Archer Financial Services. Thank you.